If I told you I had $1 million in debt, you'd probably think I needed a financial intervention, right? Well, in real estate, that same $1 million debt could be seen as okay or even not high enough. Today, we're breaking down how debt can be one of the most powerful tools in real estate investing, why using it wisely can leave the stock market in the dust, and some ways to determine if you have too much debt. Let's start with the big idea, leverage. Leverage is the use of borrowed money to amplify potential returns. Sounds risky, right? Well, as it turns out, our entire economy is built on leverage. And in real estate, it's not just accepted, it's encouraged. Now, don't get me wrong. When someone takes on too much debt, it's not a good thing. Just ask my buddies at Lehman Brothers. But without leverage, most real estate returns would be similar to the stock market, maybe even a little less, around 8 or 9%. So why go through the hassle of tenants, toilets, and termites with a rental when you could just park your money in an index fund? That's where leverage can change the game. Let me walk you through an example. Say you have $100,000. You could invest it into the S&P 500 and get a nice 10.5% return historically. After a year, that's $110,500. Or you use that same $100,000 as a down payment on a $400,000 rental property. You finance the rest with a mortgage. Now the property appreciates by 4%, which is the average historical rate of residential real estate appreciation in the US. That's $16,000 on paper. Add another $3,800 or so from your tenant paying down the principal on your mortgage, and suddenly you're looking at nearly a 20% return on your investment. That's almost twice the average return of the stock market. And here's the real kicker. Real estate is generally less volatile than stocks. There are no margin calls, and most residential mortgages come with fixed rates. That means no surprise rate hikes. Plus, when markets dip, real estate tends to take its time going down, unlike stocks, which have nosedived 50% in a matter of months. But before you start borrowing money like you're the poster child for Wall Street bets, let's talk about risk. Because leverage is a double-edged sword. Yes, it boosts returns when values rise, but when values fall, losses get amplified. For example, if the real estate market dropped by 4% and you put 25% down on your rental, you wouldn't be looking at a 4% loss, you'd be looking at a 16% loss because you put down $100,000 and your $400,000 property declined in value by $16,000. At the end of the day, you're on the hook for the bank's money. That's why I like to track two really important ratios. Debt to equity tells us how leveraged or in debt you are. If you have $200,000 in equity and $200,000 in debt, you divide your debt into your equity and get 1. That's a common target for mid-career real estate investors. But if you're younger, your debt to equity might be higher, typically a 3 or 4 when starting out. And nearing retirement, you'll generally aim for lower, like 0.5 or even 0. Now, if you're wondering where to pull all these numbers from, here's an example using my property. If you check out Zillow, you can get an approximate current value of your rental. However, beware that these values tend to be a little optimistic. After all, there's a reason why Zillow's home flipping business went bust a few years back. You can also look at recently sold on Zillow for some comps. Now, I would say my rental is maybe worth $450. And then going to my loan servicer's website, I can see that I have about $241,000 left on the mortgage. So to get the equity, I just take the $450K current property value and subtract the $241,000 outstanding on the mortgage to get $209,000 in equity. Then I take the $241,000 left on the mortgage and divide it into my $209,000 of equity to get to 1.15. For someone with my age and risk tolerance, that's actually pretty conservative. So my partners and I should think about doing a cash out refi or a 1031. And now we'll switch over to the debt service coverage ratio, which looks at how well your rental income covers your debt payments. If your property earns $1,500 a month after expenses, not including the mortgage, and your mortgage is $1,000 a month, you divide the $1,500 into 1,000 to get a DSCR of 1.5. Here's a real world example. For my property, I added up the rents from both units, which comes out to $3,585 a month. Then I subtract out the operating expenses, which includes property taxes, insurance, the HOA fee, setting aside funds for maintenance, the property management fee, and we don't pay for utilities, but if you do on your rentals, then you'll want to include that. And all of that comes out to a total operating expense of $1,448 a month, meaning that the net operating income comes out to $2,137 a month. That's the rent minus the operating expenses. So we take this number DSCR and divide it by the monthly principal and interest payment of $13.55 to get to a debt service coverage ratio of 1.58, which is a very good DSCR. Generally, you can get a loan on a property that's DSCR is 1.25 or above. Anything below 1 and you're losing money every month. So how do you get your hands on real estate friendly debt? Well, if you're buying residential properties, think 1 to 4 units, lenders will mostly focus on your personal income, credit score, and debt to income ratio. Usually they want to see that your gross income is at least 3 times your mortgage payment. If you're buying a multifamily though, lenders may take into account the rents from the other units. For commercial real estate like apartment buildings or strip malls, lenders focus more on the property's performance and your experience as an investor. But don't think that means you can just stop paying your personal bills, because your personal credit history will be taken into account as well. So to tie this all up with a nice bow, debt in real estate isn't something to fear. It's something to understand and use intelligently as long as you know the risk. Metrics like debt to equity and the debt service coverage ratio can give you a good idea on how leveraged you are. And if you're buying a 1 to 4 unit residential property, lenders will mostly look at your finances, while with commercial properties, they'll mostly look at the property's finances. But there's variations on this. For more info on debt and financing in real estate, check out chapter 2 of my free ebook, Financial Planning for Real Estate. The link's in the description. And that's all for today. But if this gave you a new perspective on real estate debt, hit that like button and subscribe for more real estate and financial planning content. I'll see you next time.